Let's get down to business. Taking a look at Wall Street, Dow Industrials up 6, finishing at 13,239. S&P 500, S&P 500 up 5 at 1,409. NASDAQ up 23 at 3,078. Yield on the 10-year note up 8 basis points at 2.38%. Oil down 31 cents at 107.78 per barrel. Precious metals moved slightly higher. We'll cover those in just a few moments. The S&P 500 index up 5 today at 1,409, now at its highest level since May of 2008, 10% below the record of 1,565 back in October 2007. One of the things pushing the S&P higher, Apple. Apple just doesn't fall, not lately anyway. Today up $15.53 at $601.10 per share. That pushed the market capitalization to $560 billion. It's the first time Apple has closed above 600. The market capitalization makes Apple the most valuable publicly traded company in the world. It's a parabolic rise. Apple is up about 50% for the quarter. Today's move, following an announcement that Apple will pay a dividend of $2.65 per quarter starting in July. Also announcing a $10 billion stock buyback program, and also that sales of the iPad 3 topped 3 million over the weekend. It all sounds a little frothy. I mean, what are they going to do next Monday? Treasuries, meanwhile, continued to drop. 30-year bond yield added 7 basis points to 3.48%. Level it hasn't closed above since September. Yields on 10-year notes rose for a fifth day. We're up 8 basis points at 2.38%. Yields haven't closed above that level since October 27th. Of course, you know, yield moves inversely to price. In a speech today, William Dudley, president of the New York Federal Reserve Bank, said the economy still faces significant headwinds and inflation is expected to moderate. Separately, Dallas Fed President Richard Fisher said there is no need for another round of bond purchases. Fisher referring to another round of quantitative easing, because the reality is that the Fed is scheduled to buy Treasury debt every day this week. I mean, this is what the Fed does. Purchases are part of the central bank's program known as Operation Twist, in which they buy long-term debt and sell shorter-dated holdings. The idea is to hold down interest rates without the central bank further expanding its balance sheet. Last Friday, we had a couple of very good phone calls about the direction of interest rates, and I think the Fed will step in with more purchases if rates move much higher. The Fed still guides policy rates near zero out to 2014, so they don't appear overly swayed by the recent positive economic data. And for now, it would be hard to see Treasuries trading outside of a range. We had a great deal of publicity last week regarding the resignation letter of a guy named Greg Smith as he quit his job at Goldman Sachs. He basically claimed Goldman screwed its own customers and called them silly names behind their backs, and I was shocked, absolutely shocked, to realize that anyone would consider this information about Goldman Sachs to be shocking. Meanwhile, there was another letter purportedly written by an employee of J.P. Morgan. And unlike Greg Smith at Goldman, this guy remains anonymous, and he hasn't quit his job. So there is no confirmation on this story. The whistleblower accuses J.P. Morgan of manipulating the gold and silver markets and warns a cascading credit event being triggered by derivatives related to Greek government debt. Maybe. We don't know if this letter is real or if it's a figment of some blogger's imagination, but it brings up some interesting points. Last week, Greece officially defaulted on its debt. Unofficially, it defaulted a long time ago. I mean, we've known for some time that Greece would not pay. The formal default on about $100 billion of debt triggered payment of $3 billion in credit default swaps. This was the orderly default, where they forced, through collective action clauses, they forced creditors to accept an event that would not trigger credit default swaps. Now, credit default swaps, these are the non-insurance insurance products that pay off in the event of a default. At least that's the theory. So far, there's been nothing to trigger a payment, though. There has been no cascading credit event. CDS, a little history on CDS, credit default swaps. They obtained their favored status as unregulated non-insurance insurance policies, courtesy of the Commodity Futures Modernization Act of 2000, which was sponsored by Senator Phil Gramm out of Texas, which just coincidentally happened to benefit Enron, where Mrs. Phil Gramm, Wendy Gramm, was a director on the board at Enron. The act was a radical deregulation of derivatives. It was an example of the now widely discredited belief that banks and the markets could self-regulate without problems. Management would never do anything that put the franchise at risk. That was the thinking. And if it did, it would be suitably punished by the shareholders. In reality, the banks did not self-regulate. They did put the franchise at risk. They were not punished by shareholders or anybody, and they were bailed out by taxpayers. The Commodities Future Modernization Act effectively ended regulation on credit default swaps by exempting derivative transactions from all regulations, either as futures or securities. And then it went further. The Act specifically exempted credit default swaps and other derivatives from regulation by any state insurance board or regulator. So, CDS wasn't futures, nor was it securities, nor was it insurance. I don't know what it was. But companies that wrote insurance typically set aside reserves for expected risk of loss and payout. But when it came to swaps, the companies that underwrote them had no obligation to set aside reserves. So credit default swaps were considered risk-free trade. They could write the policies. They didn't have to set aside reserves. What could go wrong? Well, 2 weeks ago, the International Swaps and Derivatives Association said that based on current evidence, the Greek bailout would not prompt payments on the credit default swaps, based on evidence. Typically, an option or futures contract expires. It's either in or out of the money. Any tradable asset, stocks, bonds, futures, options, funds, settles on its own. There's a market price the asset closes at, a total volume of sales, a final print for the day, the month, the quarter, the year. No interpretation required. There's a price. Then on Monday, the International Swaps and Derivatives Association, the ISDA committee, ruled that Greece formally defaulted. Well, that clears that up. Had they failed to do that, it would have fatally damaged the swaps market. It would have made foreign debt financing much more expensive. No sort of group declaration is required when a futures contract or an option must settle. No decision is required. which again is why credit default swaps look, sound, and act a lot more like insurance than they do any other tradable assets. Now, why does it matter if swaps are not insurance? And the simple answer is reserves. That's the key difference between insurance and swaps. State insurance regulators actually require reserves from insurers. They require a lot of reserves to ensure that payments can be made in the event any payable event occurs. The swaps industry does not require reserves, not even a penny against billions in potential losses. The CDS industry is in the premium collection business. They are not in the claims payment business. And that is why it really should be considered insurance. And it really should be regulated, because the simple truth is that it does nothing to manage risk. It only leaves a false impression of managing risk. In fact, because multiple people can buy multiple policies on any event, there are multiple reasons why buyers of CDS would like to see a credit event trigger multiple payouts. If ever there was a reason to support failure, it would be CDS. There is no good reason for CDS. There are multiple bad reasons. And the simple truth is that we shouldn't regulate credit default swaps. We should end them completely. There is no role for them. You're tuned to Money Radio. Thank you for joining us today for the review. Time now for the Resource Consultants Precious Metals Update. This report is brought to you by Resource Consultants. Gold up $3.40 at $1,664.50 per ounce. Silver up 36 cents at $33.02. Platinum up $10 at $1,685 per ounce. So, not a big day, but up across the board for the precious metals. This report is brought to you each and every day by Resource Consultants. Resource Consultants should be your precious metals broker. For physical delivery of precious metals, call Resource Consultants at 800-494-4149. 800-494-4149. And also, let me tell you about Wealth Protection 2012. It's coming up April 27th and 28th. It will be held in Tempe, Arizona, and I believe this is the 15th annual Wealth Protection Conference. If you'd like to find out more about the conference, go to buysilvernow.com. Buysilvernow.com and register. And if you would like to attend, register early. It always sells out. You can also get more information at 800-494-4149. Resource Consultants, 800-494-4149.